Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is a weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Since the late March low, we have seen the market gradually gap its way higher, though to be honest, it's not been as inspiring as the gaps would initially suggest, with far calmer ranges than compared to the moves of late February and early March. However, the market action as we entered May has shown some interesting patterns. For starters, just before we had an outside week, if only just in the middle of April, with bearish tendencies. This did not follow through, and indeed we subsequently saw a weekly key reversal up at the start of May. All this action since mid-March led to the formation of two patterns. Firstly, a reverse head and shoulders pattern, and secondly, an ascending triangle in between the uptrend currently 1024 and the flat-ish trend line topside currently at 1148. I detailed these and a failed bearish cat's ears pattern in my last commentary. Okay, so let's look at these two patterns. The reverse head and shoulders pattern has a primary target X in the 1270 area for harder to get secondary target X1 in the 1320 area. This latter one is coincident with the March 2008 high. The ascending triangle pattern has a primary target in the 1270 area and a harder secondary target X3 in the 1320 area. As you can see by now, the primary and secondary targets for each of these patterns are the same. It's not often that such things happen, but when they do, then they have done as they have done here. The next thing to note, which to be honest is pretty obvious, is that targets X and X2 were reached this week, on Tuesday. What we actually saw on Tuesday was an unusual key reversal up. That was also an indecisive spinning top move with a long tail on it. Hence, it was very much looks like, at least for now, the prices have achieved what they have needed to on the upside, and we're now seeing a move back down to gather ammunition. The questions now are twofold. How far will the market fall, and will it possibly turn into a fully bearish move instead of just a pullback down? So there are three areas to look at for a pullback. Number one, the upper trend line stroke neckline of the ascending triangle stroke reverse head and shoulders pattern. That's currently at 1148. Number two, the congestion area 1104, 1125 that has the short stroke medium moving average just below at 1103. Finally, three, the lower trend line stroke uptrend of the ascending triangle pattern, currently 1074. There is an additional area below this, the 50% Fibonacci line for 2022 at 1051, but I'm reserving judgment on that for the moment. Any of these three could halt the move lower and turn prices back up. And the last one being broken could actually trigger the beginnings of a bearish incentive. One other final point. Just below current levels, we have the very recent 50% Fibonacci line at 1166. Watch that, as it may well preempt all these other levels and cause a halt to decline before we see any more. Chicago corn. First off, please kindly still ignore the color change on some of my labeling. This is something that my charting system occasionally does without my permission. There is no special quality attributed to the different colors. Okay, so the move up to the heights of late April can be attributed to one key action, which subsequently led to many others. The key action was the almost weekly key reversal up that happened at the end of March, but which ended up being a lesser outside week pattern instead. That week was also a spike bottom, which along with the earlier pipe bottom in mid-March formed a double bottom, causing prices to rise. The rise continued until the weekly key reversal up made 3 weeks ago, when the hubris of the market, the bullish hubris of the market, met its bearish nemesis, at least for now. The reason for the lack of a bullish action can clearly be seen, and the one that I've spoken about some time before. You see, it's the middle time overhead, currently 836 of the April 2020 to September 2021 bullish Andrews Pitchell. This has been used as a rolling higher resistance back in early March and again at the end of April. The result of which was a fall in prices down to the congestion at 789. then down to the October 2012 high at 776. Then November 2012 high at 768, which was punched down through this week to the February 2013 high at 747. Now, we have further support levels at 735, 719, and then the rising medium moving average, currently 706. And this last one is perhaps the first real support we will see since the break below the short medium moving average. Yet I would like you to be reminded of one thing. The original April 2020 to September 2021 bullish Andrews pitchfork that started this whole move higher is still valid. Hence, nothing has changed in the picture of this longer-term bullish pattern. All we are seeing is still a pullback of this longer-term bullish pattern. And that's actually what it is, at least for now. I have to add that for now, as you never know, I have to add that part for now, as for now, as you really never know what will happen, but realistically we are still within the bullish scenario. The lower time for this pattern is currently down at 674, and until this is broken, and by that I mean properly broken, then this bullish pitchfork will still be valid. One other final point. Peeking out at the top of my daily chart on the right is Target X. This I drew back in March and is the target for the May 2021 to date, action being a rounded bottom pattern. I had highlighted this pattern back in March and it is still good. Target X is in the 890 area. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.